This is Vic's financial strategy, and today we're going to be talking about put options, which are basically the inverse of call options. It's like a mirror image. And if you haven't watched the call option video, I recommend you watch that quickly because it is easier to understand puts after you have gained an understanding of calls. Now I'm going to run through these slides very briefly and then give us a live example because a lot of these slides are similar to the call option slides. Now, put options are financial contracts that give the option buyer the right, but not the obligation, to sell a stock with the opportunity to buy back at a cheaper price. So very similar to short selling, but I'll explain why I prefer put options than short selling stock. Now, because these are the inverse of call options, we are betting on stock going down. We have the right to own 100 shares at a set price to buy back in the future. Now, we still have expiration dates that vary on put options, expirations ranging from within weeks to months to years. There is a premium attached to put options. The premium will vary depending on what put option you choose. This is the visual for put options. Very similar to the call option visual, we still have a max amount of loss. We can never exceed the amount of money we put into this trade. So if we place a trade that costs us $200 to enter, the max amount of money you lose on that trade is $200. And this is the opposite of short selling, because when you short sell a stock and you bet that price is going downwards, theoretically, there's an infinite amount of losses that you can take on. This is also why many traders tend to go for put options rather than short selling because of this max loss. On the x-axis, we see that as price moves down, so is your profits. As price moves up, you begin to take on losses. Okay, now let's briefly talk about moneyness. Moneyness is defined by three terms: in the money, out of the money, and at the money. I think it'll be a little bit easier if we explain with an example, but take a screenshot of this slide right here if you want to remember. In the money for put options is when price is below the strike price. Out of the money is when the stock price is above the strike price. And at the money is when prices are near equal. This will be a lot easier to visualize and understand with an example. Now, in the previous example, in the earlier lecture, going over calls, we talked about Apple and how we were betting on price going upwards. Let's use Apple as the same example, betting on price going downwards. Now we see Apple trading at $146 a share, and we are betting that price is gonna fall within the next couple weeks, next couple months. But whatever the reason is, we are betting on price going downwards. So I'm gonna flip over to the 1 hour candles to visualize. Now let's pick an option to trade. All of these dates right here, like I mentioned previously, these are all the expiration dates. Now our nearest expiration dates are gonna be December 9th, which expires this Friday. Today's a Monday. And in 4 days, we're gonna have an expiration. In about 2 weeks, so next Friday, we have the 11-day contracts to trade. So I'm gonna pick the December 16th. So we can flip to puts, but let's take a look at the difference between calls and puts when determining in the money, out of the money, and at the money. Now for puts, they are the inverse of calls. So the current price of Apple is 146. Everything below 147 is out of the money. We can say that 147 is at the money. So that's the quickest one to determine. What is the closest contract to 146.76? That'll be the 147 contract right here. This is our at the money contract. Everything above it, so I said above, but I'm scrolling down. So everything above this price, if we're adding price, 148, 149, this is all in the money for puts. I know it's kind of hard to understand at first, but basically if we were to own this contract right here, we have the 155 contract. And if we were to subtract basically what this is, let's just call it $9. 155 minus 9 will get us roughly 146. So this is in the money. We are focusing on out of the money for this example. Everything below this price will be out of the money. And if we purchase this 140 right here, we are paying a premium. There is no intrinsic value on this contract. Everything in the money will hold intrinsic value, but everything out of the money is gonna have no intrinsic value. So this is all premium. Now, if we were to own this contract, we are betting that price is gonna fall below 140 by this given time, or at least make a move in that direction. So let's put a visual. We are betting that price is gonna hit 140. So we'll put in 140 right here. This is our current price right here. And if we were to buy this contract, we would be purchasing it for $119. Remember, I said previously, move the decimal point 2 points to the right, and that will be your purchase price. Or you can multiply this number by 100. So we purchased it for $119. So we're gonna subtract 1.19 to our strike price, which is 140. That will get us right here at 138.81. So this is our visual. Current price, strike price, we can make this yellow. This is what we're targeting. This is what we are currently at. And this is our take profit. This is where we are aiming to exceed. Now remember, the opposite of calls. We are betting on price going downwards. Everything from red to yellow is still out of the money. The second we go in the money is when we fall below the yellow line. Yet, similar to calls, you are able to make profits as price moves down in the shorter amount of time. If price is still above the yellow by the time of expiration, which is December 16th, you are gonna be fully out of your contract and your contract will be close to zero at the time of expiration. So let's flip over to our options profit calculator, because I still think this website is a wonderful way to visualize put options and call options, and very helpful for beginners. So if we type in our symbol, we have Apple, we'll get the current stock price, and we bought a put option. So we click buy. We have the December 16th put option at the 140 strike, purchased for $119, and this will give us our profit and loss calculator. Now today's December 5th, today's Monday, the first trading day of the week. And we'll say that price is right, and we think that price is gonna head down by Friday. And if price is sitting at 140 by Friday, we just made 139% return on investment. But if price is still at 140 at the day of expiration, you're sitting at 100% loss. Now this is an example of time decay or theta burn, where price could be heading in the right direction. So 144, 142, but if it's not in the right amount of time, or it's not the quickest time possible, it's gonna be sitting at a loss. So if I was in this trade, I would want price to fall below 140 within the first trading week. So today's Monday, I would like to see it by December 9th to be close to the strike price, similar to 142, 141, or close to 140. Now let's look at our losses. Let's say that by Friday, price has not moved. Price is at 146.5. We will be sitting at a 36% loss. Now go to Monday, Saturday, Sunday, Monday, December 12th, we will be sitting at a 70% loss. This is the power of options and why they're so risky to trade, and why you need to be right about the strike price, where price is heading to, by the right expiration date. All right, now I hope that was helpful for gaining a basic understanding of put options. In future videos, we'll be talking about other option strategies to utilize. Thank you so much for watching. Stay tuned for the next lecture.